Hi, I'd like to talk to you about the steps that you should take in order to implement a relative valuation of a stock. The challenge in relative valuation is that it seems so easy. You just quickly find some comparables, you find a multiple, and you apply it. If you just pull up a Yahoo Finance page or a Google Finance page, it seems like you could almost do it in less than a minute. But while this concept and this approach to valuation seems very simple on the surface, it actually has so many hidden assumptions in it that it's one of the more complicated approaches to valuation that you can use. So I'd like to give you my 4 steps for trying to implement this, and this may be something that you want to review after you've done this valuation approach, because it will give you some things to think about and identify the weaknesses in your approach. The first step is to identify the best comparables. The easiest way to phrase this is what publicly traded companies are most similar to the company being valued. Obviously, you can't use privately traded companies because you're not going to be able to get the market prices for those. What exactly is most similar? That's a very hard concept to define. Oftentimes, it's companies with the companies in the same industry or same sector, but that's not always the case. In the investment valuation book, Damodaran talks about a comparable firm being one where the cash flows, growth potential, and risk are similar to the firm being valued, and that's a good way to think about it. When you're trying to find out what is a similar firm, think in terms of cash flows, growth potential, and risk. Those 3 things should be your focus. I like to come up with 3 to 5 comparables. Generally, if you're talking about having over 5 comparables, you start having firms that are dissimilar as opposed to similar. When you have less than 3, it's very tough to get an accurate gauge for the valuation because you're not bringing in enough information from the marketplace. The second step is to identify the best multiple. To do this step, you need to ask yourself what ratio will best represent the stock's future valuation. You'd like to buy it today if it's undervalued and sell it sometime in the future. That ratio that you're trying to identify is the one that's going to determine the stock's valuation at the point in the future when you want to sell. Oftentimes this is the PE ratio, and that makes a lot of sense. You take the price per share and divide by the earnings per share. That's how you standardize the ratio to apply it to the company being valued. Sometimes earnings is negative, so what you have to do is go up the income statement until you find something that's positive. Maybe that's EBIT, EBITDA. Maybe you have to go all the way up the income statement till you get to revenue. That becomes a very tough multiple to use, because then you're talking about comparing the revenue per share to the price per share. Those things are not consistently defined. And what I mean by that is you're taking something in the numerator that is different than something that's in the denominator. The revenue is a cash flow that basically has a lot of people grabbing hold of it. The government gets part of that as taxes. The people who are employees get part of that is their compensation. There are other expenses. The company has to pay rent. They have to pay the light bill. All the revenue does not go to the equity holders. And so when you have that revenue per share, comparing that to the price per share, it's not really defined consistently. When you think about the price to earnings ratio, that's different, because an investor can pay the price per share and get all of the earnings per share. The earnings per share is the net income that's available to the common shareholders. When we talk about defining something uniformly, what that means is you compute that multiple one way for the firm that's being valued, and you also compute it the same way for the comparable firms. Number 3 is identify the period. What time period best represents the normal earnings of the company and the comparables? You want to get a time period that represents normal earnings because these are the earnings that you should expect going forward. If the company had a legal settlement, or they sold off a division, or they sold off some securities and generated a non-reoccurring gain. You don't want to use that time period necessarily for representing the normalized earnings. This time period could be the analyst projections for the next 12 months. It could be the next fiscal year or 2 fiscal years out. It could be the last 12 months or the last fiscal year. You have all these choices for the time period. Step 4 is to decide on a premium or discount. Should the company trade at a premium or discount due to differences in risk, growth, or cash flow? If a company has higher margins, they're expecting higher growth because of a new division they're starting, or they're better able to turn sales coming in into cash flow that's available for distribution to the stockholders, this company might be valued, very well deserve a premium or a discount to the comparables that you've identified. So those are my 4 quick and easy steps. The last thing I want to mention is that there's a huge assumption in relative valuation. This approach to valuation assumes that the comparables are correctly valued by the market. And not only does it assume that, but it assumes that the company that you're valuing is not valued correctly by the market. And I want you to ask yourself, when you're done with this approach, after you've implemented this approach, why would this occur? Why would the market get the comparable company's price correctly and the company that you're trying to value priced incorrectly? There's no easy answer for this, because it always depends on the particular situation. Maybe the company being valued is not being valued correctly by the market because it's got some unseen growth potential that the comparables don't have. Or maybe it's got some additional risk, legal liability, or a division that doesn't have a viable business strategy going forward. There are lots of reasons, but consider these 4 steps when you're trying to implement this approach to valuation.